Today, we'll talk through how to do an LBO model. What we have here is a simple model test. No balance sheet, not a three-statement model, but a very easy introductory model that is equivalent to what you might get in a 30-minute model test if you're working from a template, or even up to a 60-minute model test if you're going from scratch, blank sheet. If you want to follow along, you can grab the Excel from the link down below. It's got the prompt, what we have up right now, plus a blank template and a completed model and answer key. But with that, we'll kick it off and dive right in here. And we've got the prompt open right now. Don't have to waste our time reading everything here, but basically buying a chain of airport wine bars, and we are going to assume a 12/31/22 transaction entry, 5-year hold period, and 12/31/27 transaction exit. And our whole point of doing this is to figure out our returns from the potential investment and see if we get correct answer. We've got to open a blank sheet here. We're going to build everything from scratch. No need to start with a template here. Better to understand how to do it without one. Starting off, we'll drop in a quick header up at the top, and we'll label that our transaction assumptions. Get rid of our grid lines there, and change that text to white on the header. And the very first thing we want to look at is our purchase of the target company. And we'll drop that in right up here at the top. To figure that out, we are going to look at the target company's LTM EBITDA and multiply that by our entry multiple to get to our enterprise value, or the purchase price that we are paying to buy the company. Now let's head back to the prompt and see what information we have to help inform our entry. We know we have a 12 times entry multiple. Go ahead and drop that in. And we'll head down and see if we have any historical financial info. Looks like we will have to go ahead and build out our income statement before we are able to determine our LTM EBITDA. So in the absence of that info, we'll drop in a $100 million LTM EBITDA placeholder, and then we'll come back later on when we figured out what our actual LTM EBITDA is. But using a placeholder will allow us to go ahead and fill in the rest of our transaction assumptions, and the next step, our sources and uses. After the purchase price, still up in the transaction assumptions, we want to drop in our operating assumptions. Here we'll have things like our tax rate, depreciation, CapEx assumptions, stuff like that. Looks like we've got tax rate 37.5%, CapEx and depreciation both 3% of revenue. And we've got an exit multiple of 13 times. Again, we don't need that now, but we will later. So we can go ahead and just make sure we drop in all, or at least a majority of the detail that we need right now. Cash interest of 1%. And that's probably good. We can figure out the rest later and come back and fill that out further if we need to. But our next step up here is going to be understanding our debt financing assumptions. And that's going to be the debt that we're raising to complete the deal. To do that, we'll head over to the prompt, and it looks like we have two different tranches of debt here. We've got a term loan A and a term loan B, along with a revolver. So we'll do revolver first, abbreviate term loan A and term loan B, and the info we want from those is going to be our leverage, our debt quantum or amount, our pricing on the debt or our interest rate, any arrangement fees we might have on the debt, and then any mandatory amortization we also might have on the debt. Center that, underline it, and then head back to the prompt and see what info we need to know to drop into that assumptions schedule. So we've got $100 million revolver commitment, and we've got 4 times leverage on the term loan A, 2 times leverage on the term loan B. So the amount will hard code 100 for the revolver, 4 times leverage term loan A, 2 times term loan B. To get to our debt quantum on the term loan A and the term loan B, we'll multiply our leverage by our LTM EBITDA, anchor on LTM EBITDA, and drag it down. Remember, we have a placeholder LTM EBITDA, but the mechanics are going to be the same, so we'll link it up now and then come back and fill out LTM EBITDA when we have it. With that, just updated the formatting to show a multiple on the leverage while we had that in our most recent action, we just F4 and drop that formatting on the entry multiple at the same time. Now we're moving on to our pricing. This is going to be structured as a floating rate. So we'll have a benchmark rate, in this case SOFR, and above that we'll have a spread. And our spread is going to be 400 on the revolver, 625 on the term loan A, and 650 on the term loan B. And these are in bips or basis points, which is essentially 1/100th of a percent. So we're saying that our all-in interest rate for our revolver will be whatever the rate SOFR is in any given year, plus 4% on top of that. Now our financing fees, looks like we have 1% on both the term loan A and the term loan B. Drop that in, term loan A, paste it down, term loan B. No arrangement or commitment fee on the revolver. And the amortization is 1% on the term loan A, which just means that we have to pay back, we are obligated to pay back 1% of the principal amount each year on our term loan A. Now that we have that top schedule done, we'll go ahead and we'll drop in a print screen because it makes things cleaner. If you're submitting a model test, you should have that, as well as really any Excel deliverable when you're on the job. Zoom back in so you guys can see, and we'll just do a bit of quick formatting on the side to get ourselves ready to go and crank through the test. So just a little bit of space on side, top, and we'll be working through the bottom, so nothing really to do there other than maybe give ourselves a bit more room. Now, the other important thing, we want to make sure that we label our inputs consistently in blue so we can tell which things are hard-coded in our model. So we've got that already in this Excel, but if you need to know how to do that and you don't have the color saved, just Alt-H, Fc, M, custom, tab down to blue, and you want to drop in 255. Now that we have that, we'll F4 on our other hard-coded inputs while we're up here. Everything in operating assumptions and our LTM EBITDA and entry multiple for now before we hook up LTM EBITDA. Done with the transaction assumptions, so let's copy down that header and we'll move on to our sources and uses. In our sources and uses, we're going to figure out how much money we need to complete the transaction and where all of that money we need is going to come from. So on the sources side, we'll look at where it's coming from, and we'll have cash available from our own sponsor equity, our own money, and our debt financing, which is going to be the term loan A and the term loan B. No contribution from the revolver. That is going to be a standing line of credit that we can draw on later in the deal if we need additional financing or additional cash at that time. So we'll add that all up to get to our total sources, bold it, and drop in a top border. Up here we'll have $, and then we'll look at a percent of total, center it, bold it, underline it. Term loan A, we will go ahead and link up to our amount, drag it down to get to our term loan B. Percent, we'll get a percent of total, anchor on that bottom line, drag it down, and sum up to the top, drag it over to the right. Now we can't quite fill in our sponsor equity yet because that is going to act as a plug between the debt financing we know we have and is fixed based on our leverage and our LTM EBITDA. So to do that, we need to understand how much cash we need and then bridge the gap with our equity. So we'll copy that over, update our labeling to our uses. The biggest item in here is going to be our purchase price. And then along with that, we'll have our transaction fees, anything paid to a third party like an investment bank or consulting firm that helps us out, advises us during the transaction, as well as legal expense. That's another big one in there. We'll also have our financing fees, which is additional cash paid to our lenders when they help arrange our term loan and our debt financing for the transaction. And I think we will also have some cash to the balance sheet, which is just going to be money that we put on the company's balance sheet at the time of transaction to hold and use post-transaction. Back in the prompt, we have an assumption of $10 million cash to the balance sheet. We'll drop that in up here, 10 million. Need to update that from the percent, so we'll just copy down from the exit multiple. And we will also look and see if we have assumptions on transaction fees. It looks like we have $20 million of transaction fees, so we'll go ahead and just drop that in there as well. And drag down the 13, update it to 20. And we need a little bit more room, so we'll have our cash to the balance sheet there at the bottom. And now we can link everything up. So purchase price up here to enterprise value at entry, which is the same thing. Transaction fees, dropping that 20 million. Financing fees, we'll look at the sum product of the debt financing quantum for each tranche, and then multiply that by the fee percentage for each tranche. So it's going to be 1% on the term loan A and 1% on the term loan B, $6 million total. And then cash to the balance sheet will link up to that $13 million in our assumptions. Drag down that percent of total, update the formatting, bold that sum line at the bottom, and then all of our dollars here will do accounting formatting with no dollar sign, no decimals. You can feel free to use custom formatting, but I find that accounting is clean and quick. Remember, if you're taking a model test, you won't have any of your preset formats ready to go, and you'll have to come up with either custom formatting that you type in or a quick one like the accounting. So I prefer this method, but you can do whatever you want. So we've got that, and we'll just copy over our formatting so we don't have to redo that. And now we're at the point where we can figure out our sponsor equity, which is going to equal our total uses minus the sum of the debt financing that we already have. And you can see it's plugging the gap between that $600 million of debt financing and the $1.2 billion of total uses that we know we need to get. And with that, we are done with our initial sources and uses. We'll copy down the header and kick it off on our income statement. We'll drop in our years here first up at the top. We're entering on 12/31/22, and then we'll do EO month 12 and carry that out through exit at the end of 2027. Update the formatting to years, and we've got a couple extra in there, so we'll delete that. The ones we need, we'll bold it, center it, underline it, and then we can see what structure we have on our income statement. So back to the prompt, we've got revenue, direct expense, gross profit, indirect expense, and that will get us down to EBITDA. From there, we'll take out our depreciation, take out our financing fee amortization, also take out our interest expense from the debt financing, and that will get us to our earnings before taxes. From there, we'll take out our taxes, and that will bridge down to net income. For the sum lines, we'll go ahead and bold it, drop in the top border, and just copy up that formatting. Same thing on that gross profit. Now that we have the structure in there, let's go ahead and see what numbers we have to drop in. Info here telling us we have $600 million of LTM revenue, a 47% gross margin, and indirect expense 20% of revenue. So let's drop in additional lines for percent margin, italicize, indent, and 47%. That's an input, so we'll label that in the blue color, get rid of the bolding. Go ahead and just copy that out so we have the formatting through the period, but we'll need to understand what our assumptions are as we head into our projection period. But with that, we'll go ahead and just copy that down under the indirect expense, give a little bit more room down to our EBITDA, and go ahead and calculate our gross profit, 47% multiplied by the revenue. Direct expense, gross profit less our revenue, negative 318 million. Indirect expense, we have that 20% of revenue. So we'll go negative sign, 20% multiplied by 600 million of revenue. EBITDA will add up that indirect expense and the gross profit to get to 162 of EBITDA. Depreciation, we know, is 3% of revenue, so we'll hop back up to our operating assumptions, anchor on the 3%, multiply that by the revenue. Just make sure we have that coming in as a negative number. And then now we are down to our financing fee, amortization, and our interest expense. Both of these are going to be determined by future steps in the model, so we don't actually know them right now. But we'll drop in some shading so we remember to come back and fill them out when we have that detail. Now we'll sum up our earnings before taxes, which is going to be our EBITDA plus those couple of items there. And then our taxes, we'll do negative 37.5% assumption and multiply that by our earnings before taxes. And then we will go ahead and add that to our earnings before taxes to get down to our net income. So there we have the full LTM period. And as a reminder, we're entering at the end of that year. So we're buying the company based on this year's financial performance. So with that, we know we have $162 million of LTM EBITDA. And we can now go ahead and hop back up to our transaction assumptions, link up to that 162. We'll update the formatting on that to show that it is coming in from a different section of the model. I like to use green for that. Typically, you would use green in a model when you're linking to another sheet in the model, but with a one-page LBO, I just like to show we are looking at a different section. You can do your own thing, whatever, doesn't matter. Now that we have all this LTM detail, let's go ahead and project out for our ownership of the company, that 5 years after we've bought it. Looks like we're going to be working with a revenue growth rate. So we'll bring up that same formatting that we had on our gross margin line and check what our revenue growth is. Looks like we've got 5% first year, and then after the first year, the growth rate is actually increasing by 1% thereafter. Nothing in 22. 23 should be 5%, and then 24 and beyond should be the 5% plus 1%. Go ahead, drag that out. And our 23 revenue will be 600 multiplied by the 1 plus 5%. Direct expense will drag out, and let's check and see what our margin trends are. Gross margin expansion of 0.5% in each year of the projection period. So expansion, we are increasing our gross margin. We'll link up to 2022's 47% and add 0.5% thereafter. Same dynamic on our indirect expense. We have it declining as a percent of revenue by 0.5% in each period. We'll link that up. 20% in 22 minus 0.5% in 23 and onward. Drag it out. Now we've got all of that ready to go in 23, and we can drag that out through 27. I think that's going to mess up our revenue growth rate, but we can go ahead and update that. So 5% first year and add 1% thereafter. Drag it all out. And let's go ahead and just do that quick accounting formatting. F4 after you've done it the first time. Just don't want to mess up those percentages. And now that we have it in the F4, let's actually just go ahead and might as well do it on everything while we have it in there. At this point, we are essentially complete with the income statement, pending that additional detail on the financing fee amortization and the interest expense that we'll have to circle back and update later. But until we can do that, we'll head down to the cash flow statement, which is going to be our next step. And we're going to start on our calculation of free cash flow. To do that, we'll link up to our net income. And from our net income, we'll add back our non-cash depreciation expense. Make sure we spell depreciation properly. And we'll also add back our non-cash financing fee amortization expense. But we'll take out our change in net working capital and our capital expenditures. That will get us to our free cash flow. We'll sum everything up, bold that top border. Hop back up here, we can go ahead and link up our net income. We're starting in 23 because that is the first year of our ownership of the business. We don't care about cash flow before we owned the company. It does not matter. And we are only interested in how it influences our debt paydown after we actually own the business. Start in 23, we've got that net income. Move down to depreciation. Flip the sign because we're adding that back and link it up to our income statement. Same thing on the financing fee amortization. And we can just drag down that formula because we have it below our depreciation in the income statement. Our change in net working capital, let's check the prompt. I'm not sure if we dropped that in yet on our assumptions. So we have here net working capital at 10% of revenue. Rather than doing everything in one line in the cash flow statement, we'll go ahead and calculate our net working capital down below. First, we'll hop up, drop in that assumption, copy down the percentage formatting, label it net working capital percent of revenue, and drop in that 10% assumption. jump back down to that line we just added below the cash flow statement, and then link up that assumption with our revenue starting in 2023. So 630 multiplied by 10%, and we can go ahead and just drag that out. Our change in net working capital is going to be the prior period's net working capital less the current period, because an increase in net working capital is going to act as a use of cash because we need to fund that increase, essentially. Whereas a decrease in net working capital would be a source of cash for us in our cash flow statement. And then because we need year over year information from our net working capital, we have to make sure we drop in 2022's value. Otherwise, we'd end up in a situation where we have an artificially high change in the net working capital if we're just comparing our current 2023 value versus 2022's blank cell. And we'll go on to the final item here, our CapEx. It's going to be a negative number. We'll link it up to that assumption in our operating assumptions, anchor on the 3%, and hook that up to our revenue. So we have 3% of revenue. Sum everything up in our cash flow and drag it all out. Now, from our cash flow, I mentioned we're going to be using that to inform our debt paydown, and we're going to have that running through the model. So let's just drop in a line here for cash used in debt service, cash used for debt service. Bold it, underline it, give a top border as well, just to really call that out. And we don't have that information now, but what we will do is calculate that in our next step in the debt schedule. Final item in the cash flow, we want to understand our cash balance as we progress through ownership in the hold period. To do that, we'll look at change in cash period over period or year over year. So we'll have our beginning cash, change in cash, and ending cash. Ending cash for each period will be the sum of the beginning cash and changing cash. In our 2022 pro forma year, after we complete the transaction, our ending cash is going to be that $10 million that we dropped on the balance sheet. And I actually think so we never actually updated that cash to the balance sheet to 10 million when we copy down from our exit multiple. So we'll do two things. We'll update that formatting on the exit multiple, and then we updated that cash to the balance sheet input to the $10 million that it is supposed to be based on what we were told back in the prompt. Now that we've got that all sorted out, again, we're back down here in our cash flow statement, and our ending cash is going to be that pro forma number after we complete the transaction in 2022. Moving forward a year, in 2023, our beginning cash equals the prior period's ending cash. Changing cash is cash used for debt service plus our free cash flow that we just calculated. Add up the two to get to our ending cash, drag it out, get rid of that bolding on the beginning, and we will bold all of our ending cash. And now we're good to go on the cash flow statement, other than remembering to come back and drop in our cash used for debt service when we know that detail. To get that, we'll copy down the header and kick it off down here with our debt schedule right under the cash flow. First thing I like to do on the debt schedule is add in a summary at the top, and we'll have a breakdown for each tranche. So it'll be our revolver, term loan A, and term loan B. Add everything up to get to our total debt. Take out our cash to get to our net debt, and then bold that, add in top border, copy formatting. And again, we don't have that detail now, but we will drop that in as we progress. To understand our debt paydown, let's bring in our cash available for mandatory amortization, or the amount that we have to pay back. That will inform our cash available for optional prepayment, or the additional cash we have that we can choose to prepay above the amount that we are mandated to. The cash available for mandatory is easy. We just link that up to our free cash flow on the cash flow statement. But to get to our cash available for optional prepayment, we actually need to go ahead and understand how much cash we used for the mandatory amortization. To do that, we'll start outlining our different tranches of debt. First up, we have the revolver, and we'll have our beginning balance, our optional draw for repayment, and our ending balance. Ending balance is going to be the sum of the two of those. So we'll do a sum line, but we don't have all of the detail we need to complete that yet. So we will copy that down for our term loan A. We'll have the same beginning balance, but then instead of optional draw and repayment, we will have optional prepayment because we are not able to draw additional debt on the term loan A like we would on the revolver, which is a revolving line of credit. Along with our optional prepayment on the term loan A, we also need to remember to add in our mandatory amortization. Then we'll head over to 2022's ending balance, and that is pro forma for the transaction, so we can go ahead and link that up to our debt financing in the sources and uses. It's that 648. And again, we are drawing that in from a different part of the model, so we can drop in a green input. Beginning balance equals prior period's ending balance. Mandatory amortization, let's just drop in our amortization percentage here, link it up top to what we had in the financing assumptions, and drop in that green shading, underline, center it, and we'll just drop in a border around that to clean it up. To do our mandatory amortization, we are going to look at our percentage, anchor on that, and then multiply it by the principal amount of the debt. And that is going to be the debt that we took out prior to any repayment. So we can link it up to that first ending balance in the pro forma year. But because we are paying down debt, we are reducing the debt balance, and we want that to be a negative number. And then final thing we need to take into account is potential situation when we have fully paid down our term loan A and don't have any remaining balance. At that point, we wouldn't want to continue paying mandatory amortization because we'd essentially be paying the lender money that we didn't borrow, which wouldn't make any sense. To prevent that happening, we'll use a min function, and we're going to look at the minimum of what we just calculated and compare that to the beginning balance or the amount of debt that we still have outstanding. Now, along with that, we can make sure we don't have any issues if we don't have the cash available to make the payment and prevent it taking a draw on the term loan A if our signs get flipped around. So we'll add in a max of 0 in the front, add in that final parenthesis at the end, move that negative sign out to the front there, and there we go, we have that negative $6 million of that mandatory amortization. And now that we've calculated that, it's going to be our only mandatory amortization. We don't have it on the term loan B, so we can hop back up to this cash available for optional prepayment and set that equal to the mandatory amortization plus the cash that we used for mandatory amortization. Similar idea here, we'll do a max of 0 and compare that to our value we calculated so we don't end up with a negative number flowing through the model. Right now we have 95 million of cash coming in from our free cash flow. We're using 6 million to pay down our mandatory amount, and then we have 89 million available to continue with our optional pay down. To figure out the optional prepayment, we'll look at the negative minimum of the beginning balance, add to that the mandatory amortization that we just paid out, and that will get us to the current debt that we still owe. We'll compare that to our optional prepayment, and again, we'll just hop out to the front and look at a max of 0 and what we just calculated. And you can see that we are using all of our available cash to continue paying down our term loan A in that optional prepayment. We'll go ahead and drag it all out through the remainder of the projection period. And we can hop back up, drag this out as well, bold it, top border, bottom border, just to call it out. And we now have the detail we need to continue with our revolver. No ending balance in 22 because we didn't use it as part of our debt financing in the sources and uses. Beginning balance will continue to equal the prior period's ending balance. To understand our optional draw and repayment, we need a little bit more info here. And we're going to look at the max capacity, or our revolver commitment, and our available capacity, which is going to be the max capacity less any draw that we've made. On our max capacity, we'll go to the financing assumptions that we dropped in and anchor on our $100 million revolver commitment. And our available capacity equals max capacity minus beginning balance. Now we can drag that out for both of them, and we'll italicize it for a little bit of formatting. Go back up to the optional draw repayment. And right here, we'll look at negative minimum and compare our cash available for mandatory amortization, which remember is the same thing as our free cash flow. Add to that the mandatory amortization amount we used on our term loan A. Compare that to our beginning balance, drop a parenthesis, and then we'll hop to the front of the formula and we'll look at the minimum of the available capacity and compare that to the full formula that we just calculated. Ending balance, we add the two together, and we'll go ahead and drag it all out. We'll come back in a second and test that mechanic on the revolver, but first we'll go ahead and just do our term loan B, and we'll copy down the term loan A formatting, update the title, delete our mandatory amortization because we don't have that on the term loan B. We'll relink the ending balance to pro forma 324 million that we used as part of our debt financing in the sources and uses. No change on beginning balance formula. And the optional prepayment, couple tweaks here. We'll remove that refed out part of it because that was where the mandatory amortization fed in. No change on G103, which is the beginning balance. And the repayment part, we will link to our optional prepayment cash, but we need to remember to take into account the part of that optional prepayment cash that we already used in our term loan A optional prepayment. Make sure we avoid double counting, enter, drag it out, and we don't do anything there because we are using all of our available cash to pay down our term loan A and have nothing left over to mess around with our term loan B. Delete that amortization on the side, we don't need it. And we'll hop right back up to the revolver and just double check to make sure we are looking at our mechanics properly, or that we hooked up our mechanics properly. To check it, good way to do that is to look at your mandatory amortization. Let's say for whatever reason, maybe we have an intensive CapEx project or like an add-on acquisition, something like that. Anyway, we have negative 25 million of free cash flow in, what is this, 2025. Now, because of that, no beginning balance at the start of the period. After we get hit with that negative $25 million free cash flow gap, we'll draw 29 million, of which 25 is bridging the gap from that negative cash flow back up to zero and our zero balance. And then the remaining 4 million is going to be the amount that we need to complete our mandatory amortization on the term loan A because we have to pay that. Otherwise, we are in default, which is not a good thing. With that done, ending balance of 29, hop forward into 2026, and our cash flow is back to normal. We have 129 million coming in. We have that beginning balance of the 29, but out of that 129, we repay that balance on the revolver and continue making our mandatory amortization payments on the term loan A. But if you take a look here, you can actually notice that we are paying down more debt than we have cash available in 2026. And that's because we need to make a slight tweak to our optional prepayment to take into account the situation when we draw and are repaying the revolver. So rather than only taking into consideration cash available for mandatory and mandatory, we also just need to account for that optional draw and repayment on the revolver. Drag it out, and now you notice that we are not using more cash to pay down our debt than we have available, which is always a good thing. Nearly done on our debt schedule here. We'll go ahead and link back up our cash flow statement to all of the debt repayment that we did, which is going to be revolver, mandatory and optional on the term loan A, as well as optional on the term loan B. Bring it up, drag it out, and then we'll just reverse that little hard code we made to test the mechanics. And now you can see in our cash flow statement, we have that beginning balance flowing through that $10 million because that is essentially our minimum cash amount. And we have no change period over period cash balance because we are using all of our available cash to go ahead and pay down the debt. Final quick thing here on the debt schedule, we'll go ahead and figure out the summary we have up at the top. To do that, grab in our ending balance on each of our tranches. So revolver, term loan A, and term loan B way down there at the bottom. Sum all that up, alt equals less cash, which we grab in from our ending balance on the cash flow statement. And then our net debt is going to be total less cash, drag it out. And now we've finalized our debt schedule and can move on to one of the final pieces here, which is our interest schedule. Some people like to do the interest schedule right in the debt schedule underneath the different tranches, but I find it is cleaner and easier to fully separate it out into a different section. Do whatever you feel like. Now that we have the header and the years, we'll go ahead and just copy down this schedule we have to save a bit of formatting time. And with our revolver, term loan A, and term loan B, that will get us to our total interest. Then we will have cash interest income, or income we earn on our cash balance, like if we had it deposited in a bank. And then that will get us to our net interest. Copy that down one more time, and we'll go ahead and link up to our interest rates. Right in the middle there, we'll drop in our benchmark rate, which is going to be SOFR in this example. It might be LIBOR if you are looking at an older LBO model test. LIBOR was the prior benchmark rate that SOFR has now come in and replaced. Hop into the prompt and we will drop in our SOFR forward curve, which is the projection of where SOFR is going to trend, where the rate is going to be over the coming couple of years. So we've got it called out here, 0.5%, is that 1%? 0.5, 1.5, 2.5, 3.5, and 4.5. So we'll just do that and add 1%, drag it out, add in that decimal so we can see everything, and we're good to go there. We'll drop in that blue coloring on the font so we can tell that that is a hard code. And now we can go ahead and bring in our interest rates based on our assumptions in the financing assumptions. Actually, one final thing, let's see if we have an interest rate floor or a SOFR floor. So we do. The floor is just an idea that is built into a lot of credit agreements that says essentially if your benchmark rate falls under the floor, pay the floor instead. So it just kicks in a low rate environment to kind of bolster or augment the interest that the lender is going to receive. To take that into account, we'll add in one more line here and we'll call it our effective benchmark rate. We'll go over to the side and we'll have a floor assumption, underline it, drop in 1%, center that, and note the blue hard code. Go back over here, and the floor is going to be the maximum between that floor assumption and the hard-coded SOFR forward curve that we dropped in. Black text, because it is an input, bold it, top border. We will not bold the SOFR anymore. And now we can see that in 2023, when the forward curve has dropped below our floor, the floor kicks in. We have a 1% minimum or 1% benchmark rate effectively. And then we don't have any impact from the floor thereafter because our SOFR ramps up and we just go with that. So make sure you build it in. And if you don't have the assumption given to you, a 1% floor is pretty typical. Now that we have that, hop back down to this schedule here at the bottom, and we'll set equal the benchmark rate, and we'll add to that our pricing assumption on each of our tranches, anchor on column, and divide by 10,000. Then we'll just make sure we anchor again on that line for the benchmark rate. We can go ahead and copy that down through our different tranches. Looks like we're good. Go ahead, copy that out. Our cash interest income, we have that assumption up in our operating assumptions. Head up there, anchor it, 1%, drag it all out. Don't need that final line, and then we'll just delete that. Label everything in green because we are bringing that all in from a different part of the model. And we now have our interest rates for each different tranche of debt. So with that, we'll go ahead and calculate our interest expense. The one thing that we need to do prior to that calculation is drop in our circularity toggle. And the idea behind the circularity toggle is it helps you out in a situation where you run into difficulties in your Excel calculation related to the codependency of your model. Explaining that in some plain English, in an LBO, your debt paydown is dependent on your cash flow. Your cash flow is dependent on your net income and interest expense, both of which are, of course, dependent on the amount of debt you have outstanding. So they all play into each other, and if something gets messed up in the model, things will stop calculating, and you'll have to delete part of that circularity to get it to recalculate and flow properly. The way around that is to kind of artificially delete it or artificially stop that calculation with a circularity toggle. Now we'll drop in the toggle on and off up here at the top, and we'll have that label, border, blue input, and we'll hop back down here. We'll delete that old detail that we had from the debt schedule. Return to the circularity toggle in a second, but for now, we'll look at the average on our revolver of beginning balance and ending balance and multiply that by our rate that we calculated. We have to look at beginning and ending average because if you think about it in real life, we'll be paying interest expense throughout the year. If we paid only based on beginning balance, we would be overpaying our interest expense. On the other hand, if we paid only on the ending balance, we'd be underpaying. Either way, incorrect. So we'll kind of bridge the gap there and look at the average. Quick and dirty approach, but better than not doing anything. So we've got that. A couple other tweaks we have to make there. We'll drop in a negative number at the front because it is interest expense. And then we'll bring back in that circularity toggle that we just talked about. So we'll do an if statement, F2, head up here. And if that toggle is on, if it's a 1, if it equals 1, we will calculate our interest as normal, as usual. But if it is not 1, if it's turned off, then we will drop in a 0 for the interest calculation, and we're just not going to do that interest. That way, if we have circularity issues, turn off the toggle, interest doesn't calculate, model fixes itself, and then we go back and turn the toggle back on. But we should be good there, and then we'll copy that down for the other tranches. We just need to make sure that we go in and update our beginning and ending balances. The rate flowed down properly because we set it up that way, but we just have to drop in that term loan A beginning and ending, term loan B beginning and ending, and then hop back up to our cash flow statement. We want to get lines 63 and 65, so copy that down there, and just update G65 and G63. We've got all of our calculations. Alt equals total interest. Net interest is cash interest income plus total interest. And then we have to remember to flip the sign to a positive on the interest income. Good on all that. Go ahead, drag it out through 27. And now we'll do the final step on the interest schedule, which is looking at our financing fee amortization. And we're doing that because financing fee amortization is considered a non-cash interest expense. We're amortizing the contra liability created by the financing fees we paid at time of initial transaction. Really just some annoying accounting, but essentially we're recognizing those financing fees, that expense over the life of the debt, over the term of the debt, rather than right off the bat all up front. So the two inputs that we need to bring in for that are going to be our total financing fees and our debt term. Center underline it. Financing fees we bring in from our sources and uses all the way up there at the top. At that 10 million. Debt term, check the prompt, see what we've got. Looks like 7 years on both. Because we have 7 years on both, we can do this calculation all together. If we had a different term for each tranche, we would have to break out the calculations because, as you will see in a second here, the calculation is going to be dependent on the term, and the calculation will be fees, anchor on that, divided by term, anchor on that, flip the sign to a negative, and then let's actually just bring that up one line so we line up with our amortization line over there on the side. But we've got that, go ahead and drag it out. Same thing through all periods. Now, if we had a 7-year hold period, eventually we would fully amortize those financing fees, and we would no longer want to calculate that. But we know that because we only have a 5-year hold period, we have a shorter hold period than our debt term, and we're not going to fully amortize, so we don't have to worry about hitting that maximum. Hop over here, we've got that fees linked up to the top, and debt term we just hard coded, drop in the blue. Now we're good to go on interest. Hop all the way back up to the income statement and link all that up. Way back down there. Bring in the financing fees, bring in the interest. Make sure we bring in the net interest so we account for that cash interest income. Wouldn't want to forget cash we're raking in. Drag it all out, and we'll get rid of that shading that we had to remember to actually do that part. Now, you also will have to remember to link up your financing fee amortization in your cash flow and add it back because it is a non-cash expense, just an accounting thing that we're not actually paying money out for. So we need to ensure we control for that. But we've already done that. Just if you're doing your own model, make sure you note that. And at this point, we are now on to the final step in the model. Copy down that header one last time, and we'll take a look at our exit and returns analysis. We have held the company for 5 years, put in a lot of time and effort, and now it is time to sell the business, get some liquidity, and hopefully a return on our investment and all the work we put in. So to sell the company and exit the investment, we'll look at our exit EBITDA, multiply by our exit multiple to get to our enterprise value. From there, we'll take out our net debt, and that will bridge to our equity value. Drop in a border, bold it on the sum lines, and we'll go over and link everything up. So exit EBITDA we'll take from our income statement, 269. Exit multiple, link back up top to our assumptions, 13 times. We've got a little bit of multiple expansion versus entry, which is fine. Multiply the 2 to get to our enterprise value, and then link up our net debt to that debt schedule summary we have up at the top of the debt schedule. Make sure we get net debt and make sure it is a negative. And then add the negative net debt to the enterprise value to bridge down to our equity value. So we're exiting the deal. We sell the company for enterprise value, but we still have debt that we haven't repaid. And we obviously have to give the lenders their money back. So instead of being able to pocket that full enterprise value, we lose like 600 million here to get rid of the debt. But then after that, everything left over goes back into our pocket. Now, the whole point of doing all this work was to understand what our returns look like. To calculate that, the first one we'll do is our MOIC, or multiple of invested capital. After that, we'll look at our IRR, or internal rate of return. The MOIC is super easy. We're just going to look at cash back in our pocket at the end of the deal, that equity value, and divide it by the cash that we had to put into the deal in our sources and uses, which was our sponsor equity. Enter on that, and for the IRR, a little bit more involved, but still easy. Copy down those years. We'll do it right below the print screen, and so bring that up a little bit. Bring that up there. And we're going to be looking at investor cash flows. So the IRR takes into consideration timing of the money we put into the deal and the money we put out. The shorter the time of the deal, the higher the IRR, and the longer the time, the lower the IRR, essentially taking into account present value of the future cash flows. So 2022, we have a negative number because we had cash flowing out of our pocket, and that'll be that same sponsor equity. Jump ahead to 27, and we have the equity value coming back into our pocket, same 2.9 billion. And to calculate it, we'll do XIRR, bring in our full values and the range of dates. So 12/31/22 at entry to 12/31/27, 5 years later at exit. Enter, percent, and we'll do the multiple on the MOIC, and go ahead and F4 that on the exit multiple. Call that out a little bit, border, bold it, And there we go. We've got 2.9 times MOIC, so we nearly tripled our money from the deal. And we've got a 24% IRR. By all accounts, a pretty decent transaction. Now, if you were taking this in a model test, you would want to go ahead and do a sensitivity analysis at the bottom, looking at maybe exit and entry or revenue growth. And then, most importantly, you'd have to go back up and double check all of your work to confirm that you didn't have any errors. But with that, we are all set here, and you should be good to go if you want to go knock out some LBOs on your own.